Hello and welcome to our latest Money Show Money Masters podcast segment. I'm Mike Larson, editor-in-chief at Money Show, and today we're mixing things up. I'm bringing together three of Money Show's expert contributors for a stock roundtable. It's going to be an episode where they talk about what they're seeing happen in the markets that they track and their favorite stocks to play those trends. Joining me are Ryan Irvine, president and CEO of KeyStone Financial, Tom Bruni, head of market research at StockTwits, and Sean Broderick, senior editor at Weiss Ratings. Gentlemen, how are you all doing?
Doing great.
I am excellent.
You guys could join. It's a fantastic opportunity. I know we're going to get a chance to hear from some of you guys live at a couple of our events. So I figured this would be a great opportunity to introduce you to our audience, let them know a little bit about what you're going to be saying. But why don't we go around the table for some people who may not be familiar with each of you. Ryan, just explain a little bit about your background and what it is KeyStone Financial does, and then we'll kind of go around the table.
I'm with KeyStone Financial. We're an independent research firm. We've been doing it for about 25 years. We specialize in research. So independent research, we look at every stock in Canada. There's over 3,500. There's 5,000 we look at in the US every year from a fundamental growth and balance sheet perspective to help our clients. And our clients are just individual investors and institutional clients. There's a lot of IAs that use our service as well. We help them build simple 15 to 25 stock portfolios. So kind of concentrated portfolios. They consist of quality growth stocks and dividend growth stocks. 25 years ago, we started looking at small caps. But when I say small caps, I'm not talking about penny stocks. I'm talking about companies with good, solid growth, earnings, and revenue. And today, we recommend and own the Alphabets and the Microsofts of the world, right down to a company with, say, a $20 million market cap, but it happens to be a profitable business that we're looking to find the next Alphabet and Google of the world, or those are the same company, but the next Alphabets of the world. Clients use a discount brokerage to save on fees. They subscribe to our research on an annual basis, and we help them build that simple portfolio. And you can get information on that at www.keystocks.com. So hopefully that gives you a good summary of what we do.
Great. Thanks, Ryan. Tom, why don't we move on to you? Talk a little bit about StockTwits and some of the research that you guys do specifically on the social media and sort of sentiment side.
So StockTwits is the largest online community of investors and traders, over 8 million users, hundreds of thousands of people tuning into our platform every day to kind of participate in the real-time experience of what's happening in markets. And so my job as head of market research and kind of editor-in-chief of our content business is to write our daily RIP newsletter, which is our flagship, goes out to 1 million people a day, sums up what happened in the markets in a fun, witty way. I'm working to build out kind of our broader content initiatives to create discoverability on the platform, help investors and traders find their next big idea, whether that be through a newsletter or a video content like this. We're all about helping people find their community in the markets and their next idea.
Right, awesome. I love the newsletter. I'm a big fan of the memes and some other things. I always get a chuckle out of what you guys have to say about what's going on out there. So thanks for keeping it interesting.
Thank you. Appreciate it. Yeah, absolutely.
Sean, obviously, in the past, I've worked with you for a number of years, but if people aren't familiar with your background, why don't you talk a little bit about what you do and what Weiss Ratings does?
Right. Well, let's start with Weiss Ratings. It has been around a while, started originally rating insurance companies and said that a lot of them had feet of clay when everyone else thought they were great. It turned out a lot of them were really in trouble. So that made the Weiss name. We've since moved on to rating pretty much everything. We have the Weiss Ratings for safety, also for performance, and I use those in my work. I've been a natural resource analyst for decades now, though I am a cycles analyst as well. Right now, there's an upcycle in tech led by AI, and so we've been riding that wave pretty successfully. And there's a whole bunch of areas of the market I like. I have multiple newsletters, starting with my monthly newsletter, Wealth Megatrends. That has the next edition going out Friday, and we're sending out a new gold report because I'm really bullish on gold. That goes out as well. And then I have two premium service newsletters. One is Resource Trader, which, as you might expect, trades stocks that are leveraged to resources. And then I have Super Cycle Investor, which is more focused on the whole cycle thing. So that's pretty much what I do. In pursuit of that, I've traveled from one pole to the other, and lots of places in between. And I love mining stocks. They don't seem to love me very much now, though things are changing. So it's an exciting time to be in the markets. Let me just say that.
Awesome. Since we're on you at this moment, you mentioned gold. I guess I'm going to start with you talking a little bit about the markets, and then maybe we'll get to picks later in the conversation. What do you think's going on here with this rotation we've seen, with gold breaking out? Kind of what's your big picture view of this market here?
I mean, it all depends if you wanted to talk about what's happening this year, or else what's just happened in the past month. Because in the past month we've had a decade worth of action, right? And a lot of people thought things were really going to heck in a handcart, but there's a whole bunch of things that came into that to really make people feel that the market was overvalued. And when we had news that really wasn't that bad about jobs and the market sold off a lot, that was a warning sign. Then we had the Bank of Japan tweaking the carry trade, which made it harder, or I should say not as rewarding, to actually borrow in yen and then buy stuff all around the world. That's a market no one really knows, but it's worth somewhere between $1.1 trillion and $2.8 trillion. And that really affected a lot of things on the margin, which was driving price crazy. So we had that mini flash crash. That's actually kind of the second one we've had this year, though this one was the biggest. So a lot of people are feeling spooked about the market. Now, the Bank of Japan blinked, and so that problem went away. But there are other underlying issues which are making people feel nervous. We do have some weakening economic data. Some people think we're in a recession. I believe they're wrong. We can maybe get into that later. We have inflation that was stubborn, though the latest data seems to be showing that the inflation beast is kind of hitting the snooze button again. We have political uncertainty. Boy, don't we have that here in the US. I mean, if you talk to your friends over in Europe, they think we're just insane. But an important thing is that forecasts for next quarter's earnings look like they're going to be more disappointing than the stellar earnings that we're having this quarter. And I think a lot of that is not discussed as much, but really weighing on the market, because even though earnings growth is expected next quarter, it's not nearly as good, as bullish as what we're seeing this quarter. And so that's making people take a step back and say, do we really want to be in this, especially when the AI stocks, or else stocks of companies that are using AI, they've been investing a lot of money in it, and they don't seem to really be getting as much out as quickly as investors were hoping. So that's taking some of the shine off of AI. Now, I'm still bullish on some certain AI stocks, but I can see why there is that kind of nervousness in the market. So I'd call it a nervous market. Just remember, the market climbs a wall of worry, and so that's probably the situation we're in.
Thanks, Sean. Ryan, I want to go to you because obviously Canada and U.S. markets are kind of inextricably linked, and you follow both of them. What are you seeing from your vantage point as far as the market environment, and before we get into kind of the bottoms-up analysis that you do as well?
Yeah, I'm glad you pointed out the bottoms up that we do, because I love listening to the macro about the markets, but we don't concern ourselves as much with the macro as we look at the micro. We look at the individual companies and the stories behind those businesses. Sometimes the most boring businesses out there provide the best results. Now, if you want to look at one macro theme that we've been playing into over the past year that we still think can continue, it would be the valuation gap, relative valuation gap between small and large cap companies. I'll give you an example. This past fall, the divergence between large and small cap companies, or even micro caps, reached its highest level in a quarter century. So the S&P 500, the large cap index, was trading above its historical PE ratio, while the S&P small cap 600 index traded below. There were some excellent opportunities in higher quality earnings-based micro and mid cap companies at that stage. The valuation gap today has narrowed slightly. The forward PE on the S&P 500 is about 20.1 versus the small cap, it's 14.3. But if we put this in perspective, over the last 25 years, small caps, due to their higher growth profile, have traded at a premium for much of this decade, or this century, sorry, to their large cap brethren. Now, the continued inversion of this ratio continues to be an opportunity for us. This multiple were to reverse in favor of small caps once again, as it had for the first like 20 years of this century. There's significant upside in small caps. Now, not all small caps are created equal. We would stress to focus on very high quality earnings-based small caps. And we think that is where the opportunity is. It doesn't have to be in the sexiest names out there, or the AI companies that everybody's following today. You can play into those names, but it's often the most boring businesses that service those industries that we've found the best results. And we can talk about some specific names today, but that is one theme that we continue to play into, the relative valuation gap between large and small caps. Now, large caps have been driven by that mega cap 8 that is pulling up the valuation there. So there's that at play. You've got to be wary of that influencing the overall metric in terms of price earnings, price to cash flow on the S&P 500. But, there is still a valuation gap. We're seeing some names that you can buy at reasonable prices still.
Great. Yeah, we'll definitely have a chance to talk about some of those picks and some of those ideas later on in the conversation. I do want to pivot to you, Tom. What are you seeing in this market, and what are kind of some of your sentiment indicators, the people that are speaking up on StockTwits? What are some of the messages that are coming out of that?
Speaking to the macro, obviously, there's a lot of potential headwinds in the next couple months, political elections, Fed decisions, wondering if the economy is going to pull off its soft landing or not. But we're seeing a lot of users look for what I'm calling diamonds in the rough, looking for opportunities that have such strong, kind of tailwinds behind them that regardless of what happens with the kind of macro big picture, index level performance, these stocks will still perform. And it's a great environment for that. If you look at the sector performance year to date, I think a lot of people would be surprised to know that utilities are at the top of that list, followed by communication services. Then we've got, financials right behind them. And so there are pockets of strength in each of these broader sectors that investors are focused on. So, within industrials, obviously, airlines are not performing well, but defense stocks are performing. Financials, you've got Goldman breaking out, any capital markets related stocks, insurance, JP Morgan, best in class bank. So that's working. In the utility sector, some utilities, water utilities, electric utilities, some of these kind of renewable energy related link ones like NextEra Energy. And then lastly, I think the big conversation around tech is just kind of the underperformance of every other industry group behind semis. So if you look at a lot of the popular industry ETFs that like iShares and other companies put out to track these sectors or sub-industry groups, semiconductors are the only one above their pandemic era highs. You've got software lagging, you've got social media stocks lagging, you've got even communication services not quite breaking out yet. And so the question now is like, do we see those start to catch up with semiconductors and see that be the next leg of technology? Or is, kind of semiconductors the one that's going to catch down to the rest of them? So that's the big divergence I see a lot of people talking about now. But yeah, individual stock and industry selection is huge in this environment. And we're seeing a lot of people just focus on the biggest winners and losers.
Okay. I'm definitely going to dive into individual names, but one last question while you've got the microphone here. I just, set your sentiment gauge. I mean, do people, once you have the big leaders like NVIDIA have months where they're down, whatever it is, 19% or something in a month, things like that, and some of the other big tech names get hit. Do you sense that the retail investor, that's really kind of made them pull in their horns, or do you think it's just people are viewing it as more of just corrective?
Yeah, so again, it depends on the broader theme, but right now, given the broader performance of the market is still positive on the year, we're starting to see rotation into small caps and other areas of the market that are performing well. It still is generally pretty bullish from a longer term perspective. Day to day, obviously, you're going to see sentiment all over the place in terms of people reacting to more tactical news and tactical moves in the market. But overall, I think people are still looking to buy the dip. They're just being a bit more selective given valuations and some of the uncertainties in the macro environment.
Okay, great. Sean, I guess we'll pivot to you. I'd love for you to maybe throw out a name. And again, it can be a stock, it can be ETF, it can be a sector, whatever you're comfortable with. But what you're looking at, maybe if you mentioned AI, and that kind of being something that's still interesting longer term. You also talked about commodities, uranium, gold, things like that. So I'm wondering if there's a couple of particular names you're really looking at.
Actually, we sold out of most of our AI names in mid-July. That happened to work out quite well. May have been more luck than skill, but you could start to see that things were weakening and names in the group were not performing well, even when they seemed to have decent news. So just thought it was time to exit. What I have been buying recently is smaller cap, not small cap, but smaller cap gold miners. We believe rate cuts are coming, a series of rate cuts starting in September. That is in turn what is weighing on the US dollar. And that's one of the things. There are many other things, but that's one of the things pushing gold higher because gold is priced in dollars. And so for some gold miners, ones that can control their costs, I mean, it's actually a very good time to be in them. One we added in, was it the last issue of both Megatrends or the issue before? I can't remember. Anyway, Alamos Gold. It's working out quite well for us. I mean, that's a company that's growing production, keeping costs in line. That's basically what I look for in a gold miner. I was very pleasantly surprised what Barrick Gold did when it just reported its earnings, and it's kind of the big kahuna in this space. Great revenue, great earnings, not so good on production and stuff, but I guess you don't have to be when you're that big. And they do have enough cash to buy more production, more reserves, that kind of thing. So they still should do well. I don't have any problem with the larger caps name, but like Ryan said, I'm looking at the smaller caps names now. I'm looking at a rotation into those names. And so especially if I think that the interest rates are going lower, which is what I believe, that helps a lot of smaller companies that don't have big cash piles. One thing that has been really helping the earnings of these huge companies is they have so much cash, they're earning money on that cash. Smaller companies don't have that advantage, but as interest rates come down, they'll start to look better next to the larger companies. And so that's just one of many things that makes me like smaller cap companies like Alamos Gold.
Perfect. Thanks, Sean. Ryan, when you go out there and sort of look at the universe of stocks, whether it's in the US, Canada, or both, are there groups that are sort of surfacing more often, just given the backdrop, or is it still just kind of a hodgepodge of names in different sectors? And after you answer that, I'd love to hear about one or two of your best ideas right here.
Yeah, I think that Tom and Sean were alluding to. I mean, it is a stock pickers market right now, and some of the areas that we've played into over the past year have been cash-rich, smaller companies. So, as Sean said, a lot of larger companies have been earning cash on their cash hoard. Smaller companies that did have cash over the past year have been benefiting from that as well. So you could pair those two together, and the environment becomes better for smaller companies in a shrinking rate environment. And you could see that. Now, those companies that you could buy a year ago that had a cash-rich balance sheet, smaller, growth, profitable, have done tremendously well. Quality earnings companies in the smaller sector over the last year. I think it continues to favor those companies going forward. That is the mix that we're looking for, a good balance sheet in a smaller company that may be ignored for whatever reason during this market cycle, can continue to get more attention right now. And there's some names that we're looking at specifically. Gold was mentioned. We're a bit of a chicken bleep investor in the gold sector. So because it is so volatile, there is one name that we've looked at and invested in for about 6 years now. Do you want us to mention names now? Do you want to go through that?
Yeah, that'd be great if there's one or two that you're comfortable with sharing.
For sure. It's a company called Dynacor Gold, DNG on the TSX. Now, it sounds like it's a Dynacor Group. It sounds like a gold mining company, but really what they are is an industrial ore processing company. So they mill for small scale miners in Latin America. They process the ore and sell the gold. They take a spread between what they process it for and what they sell it at. Now, it's been profitable for 12 straight years. You look at gold companies and you see this over time. Well, this company has sustained that model of profitability over the 12-year period in an area of the world where it's hard to operate, which is admirable. 5 years of increasing their dividend, 20% of their market cap is cash. So it's one of these cash-rich smaller companies as well. No debt. They're also ready to expand that model, take that mill, build another mill in the country they're in, buy another mill in another country, and look at expanding that to have 4 of these mills over the next 4 to 5 years. So you have one of the things we love investing in is a company that can have a proven profitable model in one market and replicate that in another market. And you can gain that success by doing that. Some boring businesses like the Boyd Group, which fixes cars, they buy automobile repair shops in one market, go to the next market, and just create more and more value, economies of scale over time. That's, a Dynacor is a smaller stage of this, but we think it can continue to do that. And you're paying 9 to 10 times earnings right now. So you're paying a discount to the market. It's profitable. It increases its dividend every year. We've owned it since $1.80, and it trades around $5 today. Again, you're only paying 9 to 10 times earnings. Expect 20% plus growth. Plus, it has that cash in the bank to go out and buy another mill or build another mill in another country. And, you then have a kicker to earnings. And that's what you need in a business like this. Trading at low valuations, cash in the bank, doesn't have to dilute. And those are the type of businesses that we look at. Unique situations where the market may be trading at 20 times, you buy this at 9 or 10 times, and it can grow beyond the market rate. That's what we're looking for.
Perfect. I appreciate the explanation of methodology and the name in itself. Tom, let me ask you, you mentioned a couple, some of the bigger cap names, the financials, JP Morgan, Goldman Sachs, and so on. Those are a few. And then you talked a little bit about sectors within utilities, water, and so on. Are there any names, again, it could be ETFs, could be a stock or two, beyond those that look particularly attractive or that, your members are pretty bullish on?
Yeah, for sure. I think before I share the biggest theme that we're seeing right now, or one of the biggest themes, I just want to touch on what Sean and Ryan had said. Like a lot of these underfollowed smaller microcap stocks have these very, hardcore communities on our platform because, there's not a lot of other places to discuss, these types of stocks. They're not getting mainstream media coverage until, they're bought out by a bigger player or something major happens. And so, our members our users are finding a lot of opportunities in these sectors as well, particularly in the healthcare space right now. If you're seeing, Eli Lilly and all these GLP-1 type companies, as competition heats up and their valuations are still very high, they need to find other, growth drivers for their pipelines. And so they're looking down the cap scale at some of these small micro and mid cap stocks that could be acquisition targets. So that's kind of one area that our community is focused in on the small and micro cap side. But then bigger picture, it's funny. I was preparing notes for this yesterday, and then the Starbucks news came out. But the biggest theme is basically finding or trying to find value in some of the beaten down name brands, whether that be Nike, Lululemon, Disney, Intel, Walgreens, Pfizer, Celsius. These are all companies that are very well known. They have high social followings, huge followings on Wall Street as well. And for whatever reason, maybe there was a misstep with their execution or they took their eye off the ball. But these are all brands that people agree generally that will be around for a very long time and just kind of need to figure out which dials to turn to get back on the right track. And so we're seeing a lot of conversation around those names and what's going to be the potential catalyst, what levels to get involved in, where the risk reward makes sense. And so I think there's a lot of opportunities in across sectors to kind of identify some of those, left for dead type companies that haven't participated in the massive, 18-month rally we've had. And people are starting to look at now.
All right, great.
Yeah.
Well,
can I follow up on that?
oh, please do. Yes,
sure.
please.
Like, I agree. I think there's some M&A opportunities in the health tech and biotech segment. I mean, there's some companies that have been beaten down because of these Ozempic-like drugs and the durable medical equipment sector, where they think you're no longer going to need a CPAP. You're no longer going to need some of this equipment, where they're actually seeing if you look at the numbers of these companies, they're continuing to see people are going to visit a doctor to talk about Ozempic more, for example. They still need the CPAP. You still need, there's many of these equipment manufacturers that you still need that have been cut in half and are trading at half the valuations that they did, say, a year ago, where you see that fear trade initially, and then the company doesn't really experience a drop in earnings or cash flow. And you can pick them up at, you know, they were trading at 10, 15 times EBITDA. Now they're 5, and their historic is 11, 12. So there are some opportunities there that we're seeing as well in some names. And we're trying to inch into those right now, find the quality names that have taken a beating. So it's a great point that was made there by Tom, for sure.
Perfect. Perfect. Well, Ryan, you and Tom are going to be joining us for both the Money Show Toronto, which is September 13th, 14th, downtown there. And then both of you and then Sean also are going to be joining us for the Money Show Orlando. That's going to be in October 17th to the 19th. And the couple of minutes that we have left, I guess we'll just go around the table. Can you give a little preview about, you know, if somebody comes to see you speak there, what it is you're going to be talking about and why they should join? And I guess I'll start with you, Tom.
Yeah, for sure. So yeah, my presentations will be centered around kind of retail sentiment, retail activity. You know, so much of the market, whether it be in meme stocks or Nvidia or anything that's in the mainstream, is going to have massive activity on online platforms and other, you know, other means of communication. And so I think that's an important piece of the puzzle that has, you know, jumped into the frame over the last couple of years that investors are realizing they can't ignore. And so my presentation is just going to be about, you know, what are the biggest trends we're seeing in that type of data that our platform generates, and how everyday people can start to use that to find their next big idea, to, you know, do due diligence on their you know, current investments, just as another supplemental indicator to help them navigate the market. So yeah, all about sentiment and retail, and look forward to seeing you guys there.
Perfect. Perfect. Ryan, I guess I'll tee up the same question to you.
Yeah, in Toronto, we're going to talk about simply 5 stocks that we think you can buy today that kind of play into the themes that I've been discussing today, the smaller end names, small to mid cap, plus a couple dividend growth stocks, but names that you can actionably buy that have further upside in the business right now, that trade at reasonable prices today. So we're going to give those 5 names in Toronto. In Orlando, we have a 2-hour masterclass there. So we're going to talk about what we do at our webinars across the country, how to build a simple 15 to 25 stock portfolio with a focus on for everything from the small cap end right up to the largest names and the dividend growth stocks that should be core to that portfolio, and give you 5 to 10 names that you can have a starter portfolio to start with today. We're going to have a focus too on how to find the next 10x stock. Now that sounds like hyperbole, but we're going to show 10 names that we've bought in the past that have actually done that, and show a profile of the businesses that we think have the potential to do that. And as a teaser, we're going to recommend a Canadian digital bank that just entered the US market. It's profitable, it's technology based, all digital, and it trades at about 9 times earnings now. And they just bought a bank in the US. They're going to use the same platform that's been highly successful in the Canadian market, had them growing at 25% compounded annually for the past 5-8 years. So they'll go into the US market, employ that model, which isn't used now in the US market. And they have, because they have that 10x size market, they have 10x potential to grow there. And you're buying them at a reasonable price. You're buying them at 9 times earnings today. So that'll be a teaser. We'll talk about that company today and profile those stocks that we like, that fit that profile.
Great. Thank you, Ryan. Sean, same question to you. You know, I know you still got a couple months out, so things may change, but I'm just kind of wondering what you think you're going to be focusing on there.
That's the thing. I mean, because I'll be speaking in October, which is before the election, and depending on who wins, they both have very different economic platforms as to what they want to do. But I will tell you, they both sides, and I hate to both sides anything, but here you go. Both sides still seem to want to spend a lot of money without increasing revenue. I mean, and so that's a bullish environment for gold. It usually is. Whatever stocks I end up speaking about will probably be smaller cap for the same reasons that the other gentlemen have mentioned. And also because I think that people who attend these conferences like that, because we aren't speaking about the stocks they already know. We're speaking about ones that they haven't learned about yet. So probably speaking about miners. I could be talking about a lot of topics. I believe we're in a new tech super cycle being led by AI. Even though I sold a whole bunch of my AI names, I'm just waiting for many of the stocks I'm watching to get above their 50-day moving averages. They're still suffering from the recent sell-off. They have to turn bullish again, but that's when I'm going to get very interested in them. But just bring it back to it. Both sides will spend money next year, and we'll probably see a widening gap between what we bring in and what we lay out. And so that's a good environment for gold. And so I can think of some small cap gold companies that should do very well in that environment.
Got it. Well, listen, Tom, Sean, Ryan, I really do appreciate you sharing some insights here, taking some time out. Viewers, if you're watching this and you want to learn more from these guys, they're going to be joining us for the Money Show events we have in Toronto, again, September 13th and 14th downtown, and then Orlando in October. That's October 17th to 19th at the Omni Orlando Resort at Champions Gate. Bring your golf clubs if you haven't been there. There's lots of golf to be had. And if you're in Toronto, you get the Blue Jays right next door, or even the TIFF Festival going on at the same time. So if you're a film buff, lots of reasons to come downtown. Please do join these gentlemen. And guys, thanks so much for taking some time out today to talk stocks.
We look forward to seeing you there. Yeah.
Thanks.